Us.
Good morning.
Hi. Okay, well, let's get started then. I think it's time to go. Good morning, everybody. I'd like to welcome you all to the Daily Energy Markets podcast. It is Tuesday, March the 14th. What a week it's been so far. It's only Tuesday, and it does feel like it's the end of the week in terms of markets and what we're seeing on those news headlines. So I'm delighted to be joined today by Dr. Charles Elinas, CEO of Cyprus Natural Hydrocarbons Company and Senior Fellow at the Global Energy Center of the Atlantic Council, Mark Ostwald, Chief Economist and Global Strategist at ADM Investor Services International, and Clyde Russell, Asia Commodities and Energy Columnist at Thomson Reuters. Mark, good morning. Let me go to you first, please. Let's talk a little bit about the headline of the week so far. There's no shortage of them, but the US banking crisis, quote unquote. Is it a crisis, in your opinion? We saw a little bit of impact on oil prices so far. How much impact is this going to have on, if you like, Fed policy and commodities in general, would you say, as we progress through the week?
Is it a crisis? It's certainly a problem. What we've got is a problem, if one goes to the root of it, actually induced by the years and years of zero and negative interest rate policy from the major central banks, including the Fed and all the QE, because it's and also the fact that the regulations which have been applied after the global financial crisis basically didn't address the fundamental problem, which is leverage, and it didn't actually put in place, or rather Mr. Trump, when he was president back in 2018, rolled back some of the legislation which stopped banks doing exactly what the likes of Silvergate Bank, SVB, and indeed Signature Bank have done. So there is a problem. There's no doubt about it. I think what the Fed's done with its program, there's an element of moral hazard, but it was necessary. You're put in this situation and you have to act, because otherwise there will be a sharp impact on the regional banks. So it is the smaller banks which where the problem potentially is. And I think also what we've seen in the last couple of days is, above all, how bad market liquidity is. The 2-year US Treasury, just overnight, having fallen 100 basis points in 2.5 days, has traded a range of 45 basis points. That's not a market. So, there are two aspects to it. One, there are going to be further problems. I don't think necessarily they're going to create bank runs, but two, what we also have is an underlying market liquidity problem, which is spilling over into everything. If treasuries are that volatile, particularly short dated, it has an impact on funding costs for every single position in the market. And yes, we can say that the market's no longer pricing a Fed rate hike next week. But it's really about people short covering positions, and until that dust settles, and it'll take a little while, it's going to take a while. We won't really know what the true picture is. Okay,
Clyde, good morning. Mark just mentioned lack of liquidity. It's being demonstrated in what we've seen in those financial market figures. What about oil markets? The impact of what we're seeing, if you think it's going to impact oil prices, filter through to that, and how is the liquidity looking in oil markets at the moment?
Well, I think we've already seen a sort of impact in oil markets and the pricing. If you actually look, oil, Brent was around $84 a barrel on Thursday. Then these rumors started going, and then SVB went at the weekend, and now Brent is, struggling to hold 80. So you have seen that, sort of $4, which is what, like 5% move, which is significant, but not catastrophic. It's not out of line for this sort of event. What I'm seeing is there's still no sort of problems in the commodity trading world. You see, if you actually look at the other commodities that should be affected by this sort of event, like copper, iron ore, they're all under a little bit of pressure, but nothing too severe. So I don't think that sort of short-term problems. Longer term, what Mark was saying, the difficulty of arranging finance and, money is the wheel, greases the wheels that move all of these things around the world. That might become more of a problem. But if it does, if you're sort of saying, what is the ultimate impact of SVB? If it does really stop monetary tightening or cap it around the globe, that is actually a positive for commodities in some way, because, looser monetary policy is good news for growth, good news for commodities. Then you'll have the problem in the background of inflation. Will that go down? What's going to happen with that? So what I think this SVB thing has done is just create a whole more uncertainty in the market and a whole lot more problems. On that basis, it's very hard to see a convincing case for commodity prices to rally just yet. But, short-term negative may turn into a more medium-term positive.
Okay, thanks. Dr. Charles, good morning again. Give us the point of view from Europe so far of the news in the US. We'll just stick to this banking sort of question, if you like, an impact on sentiment, on markets. Where do you think we'll see that sort of contagion filter through, if you like, to European banks, or are these two completely separate issues for the time being in terms of how the Fed is acting in the US and how Europeans and the ECB are responding?
I think there are almost two separate issues. The Europeans are looking at it. They are concerned, of course, but they are not overreacting. In the UK, as you probably heard, the HSBC has bought the SVB branch in the UK.
Oh, I hadn't heard that. I bank with HSBC. That's a bit worrying.
But that shows confidence that there is no problem with them and they're able to go and make a move like that. So Europe doesn't seem to be overreacting to it. It's the European Commission and ECB have provided some reassurances already. And it doesn't seem to have any major impact other than the impact on the price of oil and things like that. And
I mean, so far we've seen a slightly bearish impact on the price of oil. We don't know if that's come from that actually in any particular. But staying with you, Dr. Charles, on the price of oil, it's sort of been quite constant and a sort of range-bound, steady range for a few weeks now. What impact is that having, if anything, on gas prices in Europe? And what's your current outlook now that we're through the winter, more or less, in Europe? Are we feeling comfortable now that we've settled into more comfortable and more affordable prices?
Maybe too comfortable. I mean, Europe has declared the battle won, but it's not won. I mean, the IEA and others are warning that there are still problems to come. Already we are seeing problems. So in France, they're having some problems with nuclear power.
Yes.
And suddenly the price of gas has shot up again as a result of it. So it shows how sensitive it is. And it's not settled by any means. So the expectation is that later in the year, especially if China really comes back and really starts entering the market, it's going to impact gas prices further. And Europe has been very, very lucky this winter. It was the second warmest winter ever and benefited from that. But is that going to happen also next year? It's not necessarily going to be the case. So the market is volatile, it's problematic. And also there is another problem. Even though the prices have come down, they are still 3 times higher than pre-COVID. And that is affecting companies in Europe, affecting the economy. Companies are still looking at relocating to the United States. So all of these things are still a problem. They haven't gone away. And Europe needs to deal with these. And at the moment, it doesn't seem to have any ideas on how to deal with these. Europe is still pursuing this idea that gas is getting out of the way. We are going to get rid of gas by 2030. We're not going to need any more gas. And renewables will come and save the world. It's not going to happen. And Europe is walking into another crisis, I believe, later in the decade as a result of this policy. Eventually, Europe will have to come to realize that gas is part of the equation for a long time to come and needs to open the way for long-term contracts by the utilities buying more gas. At the moment, the utilities are not doing that. And the majors are coming back saying that, well, if you are not providing us with long-term contracts, you cannot go and produce projects that are waiting for production, like the area where I am, the East Med. So it's a problem that Europe has to face, and I'm not sure it's ready to face that. The environmentalists or the activists in Brussels have taken over. They are forcing the European Union in a direction that, in my view, will lead to crisis later on, because it's not solving the problems of energy.
Okay, well, we have a headline, we have a story, Mark, just to you in our news bulletin today. Germany forms alliance against the phase out of internal combustion engines by 2035. We had Biden in the US okaying an Alaska oil project. A slight, I mean, these are just headlines and a few articles, but are we seeing, the start of a slight reversal in sort of the pro-green, if you like, policies of governments, Mark, in your opinion, whether in Europe or not?
Well, I think what we've got is industry basically looking at this from a pragmatic, practical perspective and saying, look, we understand and we want to continue with this shift to renewables. We haven't put actually in any of the infrastructure in place. It's going to take a long time. In the meantime, we need solutions. Otherwise, we've got a cost base, as Charles was just talking about, which has been adjusted materially higher, impacts everything that we do, and it may not actually be viable in Europe. Governments are still very much, with that sort of whole virtue signaling part, and they're not with the program. There was a gentleman on a panel at Paris Grains Conference a few weeks ago I was with, who used to work at the IEA. He said, to be honest, I actually think that Europe is going to have to hit massive crisis for governments to act before they actually act in a way which is actually going to move this thing in the right direction, because at the moment there's just too much blah blah and not enough planning and action.
Okay, Clyde, let's talk a bit about Russian oil flows to Asia, or everywhere, but I mean, in particular, continuing to flow quite nicely, both into India, China, other countries possibly as well. And a lot of talk in the last week or two as the products embargo hit and started to filter through, that those products are also having absolutely no issue with Russian crude being blended somewhere and then being obviously rerouted and bought by Europe and everyone else. So do we still expect any slowdown in Russian flows, regardless of direction, in the next few months?
I think the answer is probably not really. I think what we've actually seen is that the oil market in particular has been very, very good at rerouting Russian oil, even from the Baltic ports and the west of Russia around to especially India. And you're starting to see that happen with the products as well. I think there's some risk that Russia won't be able to clear all its products out, but you're starting to see quite a lot of Russian products flowing into places like the Middle East, where theoretically they're consumed domestically, allowing Middle East refiners to export their output. Whether that's actually happening in reality, who knows? I mean, the oil market is a wonderfully opaque and innovative business, I think, is the tactful way of putting it. So we are seeing all this adjusting. What I think is the key question is, it's not so much the volumes coming out of Russia and even where they're going. Is Russia getting less money for what it's selling, or is the money still all flowing into Putin's coffers one way or another? And I think that's the measure by which we should be seeing whether this is a success, what Europe and the Americans have done in putting these embargoes and sanctions on Russian oil and products. Is it actually cutting the revenue for Russia? Indications are right, but I don't think it's probably cutting it as much as people hope. But overall, I think it's quite clear that the market has adapted very nicely to this, and you've seen a whole bunch of trade just basically move out of the European. If you look where the guys who actually trade Russian fuel and their coal and LNG, most of those guys have decamped somewhere into the Middle East, Dubai in particular. Yeah. So it's all actually just adjusting. Whether it's working as intended, I don't know.
Okay, what about China? Just sticking with you, Clyde, on Chinese demand. Again, we had obviously this upswing in December, Jan, compared to before, but a lot of people sort of saying, well, we're not going to really see much more impact in terms of oil demand and imports until at least the third quarter. We've just seen a headline yesterday that China is now opening up to foreign tourists. I'm not sure if that makes any difference to the economic activity, if you like, domestically and as demand for oil. So give us a viewpoint today on what the second quarter is looking like now.
I think you actually probably are likely to see a tick up in crude oil imports in the second quarter, particularly towards the back end, so that second half of May and June. I think that's when you might actually see some buying. At the moment, there's no big, huge tick up in Chinese crude imports. I mean, there is some reason for that. It's refinery maintenance season coming up in March and into April, so that cuts their import demand. It also cuts their exports of refined products. And I think the initial boost in domestic travel consumption as they abandoned their zero COVID policy, that's kind of now, it's happened. Everybody's gone and seen their family and they don't have to do it for another little while. So that, kind of takes a little bit of the froth out. But I think if we are actually expecting a strong summer construction season, more infrastructure spending, if Chinese manufacturing can hold up, all of these are very, very positive for, particularly middle distillate demand. And I think you'll start to see, actual increases in crude oil imports from sort of late May onwards. The key is always with China is price. If the price of crude goes back above $100 a barrel, they're going to be very tempted to sort of moderate their imports and dip into their inventories. We know they've got lots of inventories. They don't disclose exactly, and they never talk about what they're doing. But basically, we know that in the past, when the prices got too high, they still import, but they don't import as much as what they're actually, seem to be consuming. Yeah. And, that I think is the key thing to watch. So if prices do rise, I expect to see those imports moderate. But if prices hold around the sort of current $70, $80 trend, that they've been in for the last 3 or 4 months, then I think, we will see rising Chinese imports.
Mark, just back to you on Europe again and products. What have we seen in terms of the middle distillates and, excuse me, the sort of, any sort of change in sort of in cracks or whatever between those products? Have we seen any movement there? Has jet fuel been recovering a bit more or not in the last few? Is it expected to as we get to summer? What's the outlook for the European products price scenario?
Well, I mean, jet fuel's definitely recovered, and there has been. It's quite obvious that the desire for Europeans to travel, be that British or continental Europeans, is very, very strong despite the cost of living crisis, which is well worth noting. People are prioritizing making sure that they get their holidays and get to go abroad, perhaps above all because everything else is actually not that cheerful. So that is actually, as I rather suspected last year, being the key in terms of jet fuel demand rather than China. As the summer goes on, I think there's two issues with the summer in Europe. I went to Barcelona the end of February. I landed there. I looked out at the grass at the airport. It's brown. There is going to be a drought in Europe. We've had a big warning about a drought in the UK. There's going to be and that means that the energy crisis, the winter energy crisis that we were expecting, is actually probably the wrong one to look at. I think rather what we're going to have is a summer energy crisis, and that will basically also have a spillover effect into all sorts of oil product demand. The summer one basically will be a case of there being drought, the impact on agriculture, the impact then on hydroelectric power production, which impacts then Norway, which will probably start to pull back in terms of its exports, creating another displacement problem, and above all impact the French nuclear industry because they won't be able to cool. The river flows in Europe basically also means that demand for diesel will be impacted to some extent because there won't be quite as much traffic. So there are a lot of variables out there for the summer season.
With the summer of discontent, Dr. Charles, let me go to you. Let's switch a little bit to geopolitics, but again, how that might impact energy eventually. We saw some news again yesterday. We saw the UK, US, and Australia meeting again on the battleship, doing a nuclear submarine deal. Again, this sort of facing Asia, facing China alliance. We haven't really seen action on that front from those three since we had the Australians pull out of the deal with France, etc. What's the view from Europe, if you like, of that? And would you have an opinion on what that sort of reaffirming that alliance means in terms of China and any impact on energy markets?
Well, Europe is passing on almost unnoticed, but there is concern about with regards to China, because some of the countries in Europe, especially Germany, want to keep the avenues to Germany open. They don't to China open. They don't want to close the avenues completely. Some European companies are even thinking of, as a result of the high energy prices, are thinking of moving operations to China. I think Europe is looking at it in a different way, but they're not overly excited about what is happening between the US, Australia, and the UK. I don't see much, at least in the press here in Europe, here in the Netherlands, you don't really see much about it. There is an acknowledgement that it's happening, but not too much concern about it, not too much interest about it.
Okay, what do you make, Dr. Charles, of the news also this week of China mediating this new détente between Saudi Arabia and Iran? Any opinion on that? Could we see that coming again? And what does that mean for resumption of talks, perhaps the JCPOA and a more peaceful future in the Gulf here?
Well, there is a lot of hope on that. I mean, there is a lot of hope building that rapprochement between Saudi Arabia and Iran will eventually lead to sorting out Yemen and getting it out of the way, stopping the problems in the Middle East, and generally helping the geopolitics of the region. But it shows how strong China's presence is becoming in that region and how weak the United States appears to be in the region, unable to even get involved in the process. It is cut out of it. China is successful there. China is now taking initiatives in Ukraine. Which way that initiative in Ukraine will go, we don't know. What is the ultimate purpose of it? We don't know. Is China trying to demonstrate the willingness to help in Ukraine? And if there is no response, then it will go and support Russia militarily. We don't know. But it's interesting that China is now flexing its muscles outside its borders in a way that we have never seen before. And at least in the Middle East, it's having a positive impact, unlike the American involvement so far.
It seems to be more of a statement from Saudi Arabia than China, I'd say, allowing that role, if you like. It's not the US who's trying to make nice, it's China now who's taking your place. Let's look at that poll question today. Does the SVB rescue and other banks, of course, one or two others in the US so far who've triggered that, mean that the Fed hawkish policy is done? Yes or no? Mark was of the opinion at the beginning of the conversation, no, but that there may be fallout for the smaller banks, but otherwise that Fed policy probably will continue, maybe conservatively. Let's submit our responses to that. Mark, sort of on that front of Iran, OPEC, again, any talk of, they've been quite quiet actually recently, and a lot of the opinion in terms of oil supply, the whole oil supply equation, global oil supply, they're pretty intent on sticking to what they're doing. Would we expect them to move, or expect that they would be thinking they have to, because of Russian possible potential problems in Russian production to come? We haven't seen that yet. Many people are saying that's going to start to filter through at some point, either because revenues are dropping or because they're having actual problems on site. Do we think that OPEC is ready to fill any gap if that should materialize from Russia?
I mean, I think at the moment it's the case that OPEC feels fairly comfortable with what it's done and with the current state of play in the market. It knows that there's the overall level of supply in the market's quite tight. But on the other hand, they keep on moaning about the fact that there's not enough upstream investment and suggesting that the market's really tight. But then if you look at, say, forward markets for Brent, we've got a 20% discount, which basically says somewhere along the line, either it doesn't matter about the investment and demand is going to fall off, or it may be the case that after all the volatility that we've had, that a lot of particularly shale oil companies are taking the opportunity at the moment to re-hedge. So maybe the price structure of the oil curve isn't actually telling us that much. But I think for the time being, OPEC is more than comfortable to sit and wait. It's a very murky economic outlook, and they can't see any need to act. And I'm sure that they will act if their problems do become acute. But for the time being, I don't think they feel that they probably can just sit back and watch.
Okay, Clyde, what about the contagion into Asia from what we're seeing in the US? We saw Asian markets, China in particular, finally in the last few months, the equity markets recover, making up a few losses post-COVID as it emerged from that. We've seen obviously that those Asian markets react in the last 48 hours negatively. But in terms of more medium term, will they remain, in terms of the growth story, can they remain isolated from any impact that we may see on recessionary expectations in the US or in Europe for that matter?
I think it would depend how bad the situation gets with SVB, if there is contagion or whether it's contained. Certainly, China drums to a different beat at the moment. Its economy is, while it's very interlinked trade-wise with the rest of the world, its economy is in a very different place. They've got growth coming through. They don't have an inflation problem. They're in a very different space at the moment. And they're actually putting stimulus into their economy when everybody else is trying to take it out. So yes, I think they are effectively decoupled at the moment in some ways. The rest, the developed parts of Asia, Japan, South Korea, Australia, they're very much more exposed. Our markets tend to follow those in America. So if there's a bank problems there, you can see that happen straight away in Tokyo and Sydney and places like that. The rest of the region, India, I was in India a couple of weeks back. I've never seen the place as bullish as it is currently. Everyone is expecting great things from India. They are expecting strong growth. I was at a coal conference. Those guys were, coal is back. King Coal is here to stay. They were super, super bullish about everything. And I think, if you travel around Asia, there's a feeling that, the continent as a whole is actually doing quite well. Yes, there are pockets of problems. Pakistan can't really afford to buy energy, and it's got problems. But overall, the feeling is quite bullish. And I think, that helps drive these positive expectations of not just China oil demand, but Asian oil demand is going to lead the world. Will it be more than enough to offset any declines in Europe and the States? My current thinking would be yes. But, at the moment, I still see plenty of oil around. There's not a shortage of oil. The problem is actually in refined products. There's not enough diesel.
Okay, we'll see how the summer impacts that. Mark, I'll let you have the last word. Just look at the result there, a resounding no. Hawkish policy is not done. But Mark, not done, but will we see a slight sort of subtle change? We already saw them back off a little bit the last month or so. We're going to be, yes, we're continuing, but now it's going to be 25 basis points, etc. Do you expect sort of another subtle change, if you like, as a result of the nervousness that we're seeing? Or as you said at the beginning, this is just very temporary, and the Fed will continue strong and convinced for the remainder of the year on its dot plot, if you like.
Well, I always felt that there was no reaction to what Jay Powell said last week in terms of we could up the pace again. If they'd up the pace again, regardless of, if we didn't have it, they would have also had a credibility problem. So I think, the poll is right. They're going to be cautious. We are still not far away from the end of the Fed rate hiking cycle. The cumulative effects of their rate hiking cycle, this is the important part of the SVB collapse. normally these things happen with a big lag. So it's only now that you are start to see the impact on balance sheets at the financial institutions. And that, if we see a sharp tightening of financial conditions, and that's the more important part, then the Fed will basically rein in its hawkishness, because it doesn't want to, it wants financial conditions to be tight, but not to the extent that it becomes a systemic risk. And that's really going to be moving into the front and center of their considerations.
Okay, well, thanks very much, Mark Oswald, Clyde Russell, and Dr. Charles Elinas for joining us this morning. Have a great remainder of the week.
Thank you.
Thank you.
Thank you.
Bye.
Bye.